Hi, this is Nicholas Vardy, quantitative strategist at the Oxford Club. Today, I want to talk about 3 critically counterintuitive rules of investing. If you're a reader of my columns at libertythroughwealth.com, you know that I'm a big fan of mental models. After all, mental models are the ways that we humans organize our reality and understand our world. Mental models also offer you rules of thumb. Psychologists call these rules heuristics that help you make better decisions in your daily life. I have dubbed these mental models critically counterintuitive rules. These models are critical because once you understand them, you realize that little else matters. They're also counterintuitive because few of these models feel right at first. In fact, they often lead to the exact opposite of what you would first have done. So today, I want to discuss 3 of my favorite mental models as they apply to investing. Mental model number 1, the map is not the territory. This is a meta model, a model that applies to all other models. All of us investors have a map of the world, from little old ladies in Pasadena to the heads of the world's most successful hedge funds. But it is crucial to keep in mind Polish scientist Alfred Korzybinski's observation that the map is not the territory. Think about it. Even the very best street maps are imperfect. All maps are just representations of reality, a snapshot of a point in time. In the same way, there is no perfect map for investing. There is no single holy grail. Each investment philosophy, whether it's growth, value, or momentum, is just a map. You can also think of each as a specific lens through which you understand your investments. You'll find that your philosophy needs to fit both your individual preferences and current market conditions to be successful. Mental model number 2, fooled by randomness. This mental model became deeply etched into my mind after I read Nassim Taleb's Fooled by Randomness, The Hidden Role of Chance in Life and in the Markets. Taleb argues that much of what happens in the world is the product of random events. The way your life turned out, your success or failure, the spouse you married, the chance meeting that launched your career, is more the result of random events than you care to admit. Taleb argues that we are, quote, fooled by randomness when we weave stories, what he calls narrative fallacies, to explain the causality of events that are actually outside of our control. In truth, outcomes in our lives are less predictable than we think they are. The lesson for investing: if you win big on one particular stock by buying it just at the right time, you can chalk it up to dumb luck as much as you can to your unique insight. Mental model number 3, Mr. Market's mood swings. Benjamin Graham introduced Mr. Market to investors in Chapter 8 of The Intelligent Investor to represent the vicissitudes of financial markets. As an investor, you should view Mr. Market as a business partner who offers to buy and sell you stocks every single day. As Graham explains, Mr. Market is a pretty unstable character. Sometimes he wakes up happy and sometimes he wakes up sad. Your job is to take advantage of his mood swings by buying when he's down in the dumps and selling to him when he's euphoric. Warren Buffett has said that if you read this chapter, along with chapter 20 on margin of safety, quote, you don't need to read anything else and you can turn off your TV. Now, understanding these critically counterintuitive rules have led me to yet another critical and counterintuitive conclusion. It's highly unlikely that you'll become rich by following conventional wisdom, but you just might stand a chance by doing the opposite.